Chapter number 11, financial instruments, IFRS 9. Chapter doesn't make any difference. We talk about the topic. The topic is financial instruments. And the things which we are going to talk about, we'll talk about financial instrument, their presentation, their measurement, their recognition, etc. Like we say that in most standards, we talk about when to recognize and how to measure and how to present. And this topic is very important. This is definitely going to be an exam because recently the standard has changed and you've got now the new standard, which is called IFRS 9. The previous standard was IS 39, which was cancelled. Why the standard was cancelled, we will discuss a little bit of that also. But now we are talking about the new standard IFRS 9 financial instruments. And within financial instruments, we have financial assets and we have financial liabilities. And we'll talk about the measurement of that financial asset, the presentation of that financial asset, similarly, measurement of financial liability and presentation. So explain the need for an accounting standard of financial instrument. Define financial instruments in terms of financial assets and financial liabilities. Indicate for the following categories of financial instrument how they should be measured. We talk about amortized cost and fair value. So these are the two methods. If you remember, in your if I could relate it, that when you had your tangible non-current assets, you were measuring them at cost model. You said that you can measure it at cost model, or you measure it at fair value. Two things. So fair value is here also, but instead of cost model, you have got here amortized cost. You use the word amortized cost. And what is the difference and how do you calculate amortized cost? We will discuss. So this is actually an area amortized cost. We'll spend something like 15 minutes on this thing only. Explain the need for an accounting standard. The only thing which I would like to speak here, that whenever a new standard comes in, definitely the old standard has some limitations. The old standard has some lacking, and that is the reason that the new standard comes in. So we understand that definitely there was something wrong with IS 39, and that's why they canceled that standard and they brought the new one. And when they brought the new standard, what was the major difference? If you understand, remember from the previous lecture, we were talking about leasing, and we first discussed that the leasing old standard was IS 17, what were the problems, and then came the new standard IFRS 16, and how they tackled that problem. So our focus on leasing was that. Similarly, when I explained you the chapter revenue, which was IFRS 15, I definitely explained you that what was the previous standard IS 18? What were the problems in IS 18? Why did they stop it? And when they brought IFRS 15, how did they solve that issue in IFRS 15, the revenue? Similarly, what is IS 13 problems? And why did they bring the new standard? And how did they solve those issues? Now, before we go on, actually IFRS 9 is a huge thing. It had a lot of debate, and this standard, it took a lot of time for preparation. Now you can understand that it just came last year. It is number 9. You already had 10, 11, 12, 13, 14, 15, 16, and then comes 9. Actually, 9 came before 16. 9 came before 16. But 9 came after 15 because 9 was not being finalized. I mean, they started 15 and they completed 15, but they could not finish 9 because 9 was taking a lot of time. And that is why 9 came after 15. Now, what is the issue? One thing, I mean, there are many things. Actually, usually I run this training IFRS 9, it takes me 8 hours. It's a professional training IFRS 9 financial instrument, which usually we run in the banks. We are not going to discuss on that level because that is not needed in F7. And we don't need to go into all of the details. But one major difference I will tell you, which has, I would say that, shocked this conceptual framework and the entire accounting thing. And that is the concept of, expected credit losses. One thing which they introduce here is expected credit losses. Now, this is a very fundamental difference in your accounting understanding. You don't do accounting like this. You have never done accounting like this before. And that is why we say that IFRS 9, it is one of the most biggest, it is the biggest change in the financial reporting because it introduced the word ECL, expected credit losses, which means that you have to book your future losses now. Anything which you expect to happen in the next 12 months or in the next 3 years or probably in the life of the asset, you record the losses now. So far, our understanding is that we only record our, gains and losses which have incurred. We say that financial accountants, they record historical information. The very definition of financial accounting is to record historical information. Historical information means the information, the activities, transactions, events which have taken place. So anything which will take place in future, we usually are not booking it as our loss. But here we are talking about expected credit losses. That's the biggest difference, ECL. Anyways, we'll start now chapter. We got some a little bit of overview and understanding the importance of this thing. We say distinguish between debt and equity capital. Okay, we'll talk about it. Apply the requirements of relevant accounting standards to the issue and finance cost of equity, redeemable preference shares, convertible debt. Don't get scared. We'll discuss it one by one. I'm 100% sure and I'm committed that this standard I'm going to give 2 lessons today and next. We are not going to finish it in one day. It's a long standard. So this is our entire chapter. We'll talk about financial assets. What are the definitions? What is a financial asset? What is a financial liability? Types of financial assets. Then within financial liabilities, you have debt instruments. You may have equities. Within classification, we talk about debt instruments, equity instruments, and convertible debt. 3 types of instruments we'll discuss. And need for a standard I just told you, and we'll discuss it further. So this is the entire summary of this chapter. I just put it on one slide. Issue. In recent years, there have been many changes to number and variety of financial instruments which are available to companies. So what is a financial instrument? We are going to discuss that. The main issues have surrounded how they are measured and classified, presented in the financial statements. Whether a financial instrument should be classified as debt or equity is an important consideration, mainly because of the effect that this decision could have on a company's gearing ratio. Gearing ratio means the equity and debt, and there is a definite need for consistency. First, we speak about the definition. A financial instrument is a contract. Now, you should pay attention to this definition. Is a contract that gives rise to both a financial asset and of one entity and a financial liability or equity instrument of another. So the things which you should be paying attention to is a contract. There should be a contract, and there are 2 parties. For one party, there will be a financial asset. For another party, there would be a financial liability. Liability means outflow of cash. Always remember, liability means that there will be outflow of cash or equity instrument of another. So for example, a loan agreement from a bank signed by a company would be a financial instrument because the bank would show a financial asset in its financial statements, and the company would show a financial liability in form of a loan. So that piece of paper, now that is an asset for the bank because that piece of paper has been signed by the customer that I owe you $10,000. So that's a $10,000 loan contract. So on one side, one party would call it an asset. For another party, this is a liability because one has to receive, the other has to pay. So a financial instrument, it's a contract which gives one party a right to receive, another party an obligation to pay. So I'm saying a right to receive and an obligation to pay. So before we move forward, let's discuss what type of financial assets we have. So first thing you should remember that your financial instruments are divided into two parts. You call them financial assets and you call them financial liabilities. So let's first talk about financial assets. Listen, you've got different types of assets. You heard about current assets, non-current assets, tangible assets, intangible assets, and sometimes in some other language we call it movable asset or fixed asset, etc. But then what is a financial asset? Is my building my financial asset, or my inventory is my financial asset? The answer is no. Financial assets, we start with very simple. Like we say that it is a loan which you have given, like loan which you have given, not which you have to give. Which you have taken will be liability. A loan which you have given. Okay, so that could be a financial asset. Or probably you have a receivable from a customer. That's a financial asset. Or maybe you've got cash. Even cash is a financial asset. Sometimes students, they believe that financial asset is something which only banks and financial institutions are dealing. No, all of us, we are subject of financial asset. For financial asset, it applies to all of us because we've got cash, because we've got receivables, because we've got loans which we have to receive. These are my financial assets. Now, why do I call them financial asset? You should remember that the criteria for being called a financial asset, the criteria focuses on two things. One is a contract, and the other one, it has a right to receive and an obligation to pay. A right to receive and an obligation to pay, which gives rise to both a financial asset of one entity and a financial liability of another entity. I would rather write it down like this: that a contract which gives a right to receive. I'm using the word a right to receive. Receive what? I will explain, but it is a right to receive and an obligation to pay. Now, right to receive what? I will explain, and an obligation to pay. So one party gets a right, and the other party gets an obligation. So if I talk about my receivables now, when I make an invoice and I send it to a customer and the customer accepts this invoice, so this invoice is a contract which creates an obligation on the customer to pay, and the supplier has to receive. So supplier has a right to receive this amount and the customer has an obligation to pay, and there's a contract in between. The amount is known and the timing is known. A bank loan could be a financial asset because the borrower has to pay. So, right, similarly, when you talk about cash, actually a cash is also, when you see a currency note in your hand, that also is a contract. It's a contract between the holder, like you, and your state bank, who promises to pay the money, who promises to deliver the value. So these are my financial assets. Now, what would not be a financial asset? For example, if you talk about your building, and that building is probably 100 million, I don't care if it is 100 million, even such a big thing, but it is not your financial asset. You cannot call this building your financial asset. Even if the value is 100 million, doesn't make any difference. It could be your tangible non-current asset. You can call it tangible non-current asset, but you cannot call it, a financial asset. Why? Because there is no contract. You don't have a right to receive cash. The building is there. The value could be 1 million, value could be 2 million, value could be 10 million, but nobody has promised to pay you this cash. So you don't have a right to receive cash or right to receive another asset. The building is there, but you're not sure when you will sell it how much you will make or how much you will get, because there is no promise. Similarly, if you talk about your inventories, so this is also, again, it is not your financial asset. The logic here again is the same, because inventory is there in your warehouse, but nobody has made a promise to pay you. I mean, you can sell it tomorrow, you can sell it after 1 month, you can sell it for $100, you can sell it for $150. There is no promise. There should be a right to receive cash or a promise. There should be a promise in between. Yes, your inventory, it may become financial asset. It may become financial asset if a customer promises to buy on a certain date at a certain amount. If a customer comes in and says, you sell furniture. So he comes into you and he says, I want to buy one table from you. How much is the price? You say $300. And he says, I will come and I will buy this table from you on 30th of June or on 30th of April. So he makes a contract. Now that contract gives you a right to receive cash because the customer has promised that he will buy the table on 30th of April. Under these circumstances, you can call your inventory a financial instrument. Now this financial asset comes in. So you see now there is a promise which has come in, and this is now called your financial instrument. So similarly, when you create a financial instrument, a financial asset, for the other party, there is a financial liability. For example, when I talked about myself, for me, it was a receivable. So for me, it is a financial asset. But for my customer, it is a financial liability. So financial liability is just the opposite, the other side of the table. When I gave loan to someone, for me, it was a financial asset. For the other party, it was a financial liability. And the same rule applies to all of them. So one financial asset would give rise to a financial liability of the other party. So this is some example. We move forward. We say definition of financial asset is a cash, and we say that a financial asset would be an equity instrument. Equity instrument of another entity, not your own share. Equity instrument means shares, equity shares. But equity share if you purchase in some other company. Or it is a contractual right to receive cash or another financial asset from another entity. For example, trade receivable. So you have a trade receivable in which customer promises to either pay cash or pay something else in return. And it is a derivative standing at a gain. Here we come up, what is a derivative? A financial asset could be a derivative standing at a gain. I will explain this thing. I'll go to Excel file. It will take me 15 minutes to explain. But before I start explaining derivative, I just want to see one more slide and then I go back to explaining this thing, what is derivative. So first understand what is a financial liability. A financial liability is a contractual obligation to deliver cash. So obligation is there to either deliver cash or another financial asset to another entity. For example, trade payable, debentures, loan. So when you have payable, so either you give cash to your supplier or in return you give something else. So it's an obligation to pay. Actually, a financial liability is an obligation to pay. Obligation to pay. In which form? That could be different. Or probably a derivative standing at a loss. So in financial asset, we said that derivative standing at gain. Here we say derivative standing at loss. So what is derivative? Be patient, I will explain. Or a financial liability could be an equity instrument in any contract that gives the holder a residual interest in the asset of an entity after deducting all its liabilities. So let's first go back to the basics and we understand what is a derivative. I need to go back to Excel file. We will discuss it there. So let me share with you Excel now. We come here, Excel. So we need to understand, and I'm talking about financial assets, and we discuss the types. What we are going to discuss now, we create one example. We create one example and we start with that. A very simple example, very typical example. A company needs to pay 100,000 USD in 60 days, which means let's call it 30/04/2018. Let's suppose local currency of the entity is AED. So it is dirham. It is UAE dirham. So let me call it here. Let me call it like this. A UAE company needs to pay $100,000 in 60 days. So you have to pay, okay, pay home $100,000 in 60 days to its supplier. Let's call it like this, to its supplier. So you have to pay $100,000 in next 30 days to your supplier because you purchased some goods, and you have to pay it on 30th April 2018. The local currency of the entity is AED. I use the word spot rate. Spot rate, which means today's rate. Okay, today's rate. Today's rate is like 1 USD is equal to 3.5 AED. So this is your today's situation. When you receive this invoice, what you do, you immediately convert it, and book it in your books at today's rate. So which is like 1 to 3.5. So it means that you would say debit purchases, what you purchase goods, and you would say credit payables. But you record your books in how to say in AEDs because your local currency is AED. And then how much is it? $100,000 multiplied by 3.5. You record it as $350,000. 350,000 AEDs here. Okay, and you record here 350,000 AEDs. And by the way, we are going to discuss your foreign exchange standard also. They are very much related. I book this liability in my books. It's my liability as of today, and I know that I need to pay in 60 days. Now there is a fear that AED may lose value against USD. You are afraid that your local currency will become weak, probably to 3.8 AEDs to 1 USD. You are afraid, you are scared that if that happens, if AEDs become weaker and USD becomes stronger, I need to pay 380,000 AEDs. I mean, my liabilities as of today, my liability is 350, but it may become 380. If my local currency becomes weak, it will happen like this. And of course, there's a 30,000 AEDs loss. It does not happen now, but I'm just afraid. So what I need to do, I need to protect myself. I need to protect now. The business needs to protect this situation. You cannot sit down and pray to God that God please save us. You must take some action. What you will do, you will go to a money market, and you will make a contract. You make a contract to buy USDs in future date. You want to secure your position. You want to make yourself safe. So you go to the money market and you talk to a money market agent and you say, listen, on 30th April, I need $100,000. Tell me now how much you will give me. You make a contract with me, a fixed price contract. I come on 30th April, I take from you $100,000, but the value you should give me now because I cannot live with this uncertainty and I cannot, leave these things unopened. I have to close my risk. So what you will do, you will make a contract. The contract will say that, 100,000 USD after 60 days at 1 USD equals to 3.7 AED. So this is the offer he gives you. He say, I will give you the price 1 USD is equal to 3.7 AED. If you are willing, you can buy. Now you already are afraid. You feel that it may go up to 3.8. So you are happy to purchase it at 3.7. So even if you are buying it now at 3.7, you have 350,000 liability here, but you are buying it for 3.7. So you still have something to lose, probably. But you know your situation. You know how it will happen. You will know that it will not go to 3.8. I will not have to pay 3.9 or even 4. I'm securing my position. So this type of contract which you make, you call it a forward contract. The name of this contract is forward contract. This forward contract is what? This forward contract is a promise which gives you a right to purchase 100,000 USDs after 60 days at a price of 3.7. And there is some price of this contract, the cost of this contract, okay? Because they did not give you the contract for free. And you paid probably, I don't know, 2,000 USDs for that contract. So you paid $2,000 to buy this contract, and then you come back home. You already know how much you have spent, and when you will purchase the goods, when you will buy the goods, you will calculate your cost of sales on 3.7. You will do your accounting on 3.7. You know that 3.7 is the fixed price for me, and ultimately you will transfer this difference of 20 cents to your cost of sales and to your customers because you will value your things on 3.7.
Sir, one thing, this forward contract is going to execute. Like this is not the obligation. This is
no. I will speak that thing. I will speak execution will happen or not. I will tell you when I will talk futures. Okay. So this is 10,000 USD after 60 days. Then what happens? You are coming closer. The contract is for, the date of the contract execution is 34/2018 because this is the date when you need the cash. Then comes 20th of April 2018. The market price is like 1 USD is equal to 3.9 AED, let's suppose. Now you know that this contract gives a right to purchase $3.7 AED. Market is already at 3.9. So it means that this contract, it looks a very attractive proposition. I mean, anyone who has this contract in their hand, they are happy because this contract gives you a right to purchase dollar at a lower price than what is in the prevailing market. The market price has gone up. So this contract brings benefit to anyone whoever holds this contract. And therefore, what will happen? If somebody now comes to me and say that, you've got this contract, can you sell it to me because I also need dollars? And it will help me to buy dollars from the market. I say, yes, I can give it to you for say 5,000 USD. Or probably 4,000 USD. And you would say that, listen, you purchased this thing for 2,000. Why are you selling it for 4,000? And my answer will be because you will make benefit out of it, because this contract is you call it standing at gain. Standing at gain means whoever has this contract, he will make a gain. So you call here, in this situation, I can call that contract is standing at gain. Standing at gain means that whoever holds the contract will make a gain from this contract, because from market you can buy cheap. So I increase the price. If you want, you can buy it. Alternatively, what could happen? Let's suppose that on 25th of April, 2018, the market moves like this. The market moves like this, 3.680. Now, when it is on 3.680, the market you can buy dollar for 3.680. The contract requires 3.780. Now this contract is no more, an attractive option. In fact, it's a liability. It's a loss. Whoever has the contract has to pay 10 cents on every dollar purchased. You call it standing at loss. So this is a contract standing at loss. Standing at loss means that it would result in loss. So, and naturally speaking, if somebody now comes in and says that, you purchase the contract. Now, if I want to sell this contract, now nobody would come to me actually, because this contract is no more an attractive option. If I try to sell the contract, its value is zero, because nobody would purchase it. This contract is giving a loss. Nobody's interested. If I tell someone that I've got a contract which will enable you to buy dollars at 3.7, they would say, are you crazy? Dollar is already in 3.6 in market. Why would I go and buy at 3.7? So I can just tear it and I can throw it. So what is happening now? The contract price, the value of the contract, it is moving from 2,000 to 4,000 or from 2,000 to 0. And why it is changing? It is changing because of the price of the dollar. As the value of dollar goes up or down, the value of the contract goes up and down. And here comes the word derivative. So the definition of derivative is that a derivative is a financial instrument. And you see, it is a financial instrument because there's a promise to pay. There is, an obligation to pay and a right to receive. Is a financial instrument which derives its value from the value of the underlying item. So derivative means that a financial instrument whose value depends on the value of the underlying item. In our case, the underlying item is USD. In our case, our underlying item is USD. So as the underlying item, USD, its value is changing. The value of this piece of paper is also changing. If let's suppose in market, if I suppose that in market on 30th of April, on the execution date, the value of the dollar, it moves like this. It becomes 4.3, 4.5. That sounds crazy now. This contract is giving you at 3.7, market is 4.5. Anybody who has got this, it would be a fortune. And you know what I would say? I say I'm selling it for $6,000. Now I will not sell it for 4,000. I would further increase the price. I will charge more because anybody who has this thing is going to make a lot of benefit. So the value of the contract is changing. So that is called derivative. A derivative is a financial instrument who derives its value based on the value of the underlying item. And this process, what we are doing is hedging. The process, what we are doing is hedging. Hedging means to protect. In English language, hedge means to protect. So what we are doing hedging. We are trying to protect ourselves. And we have got hedge item. Our hedged item is what? Our hedged item is USD. What are we trying to protect? USD. And our hedging instrument, how did we? Hedging instrument is the method through which you protect. And my hedging instrument is that forward contract with me. So what I do, that with the help of the hedging instrument, which is a forward contract, I protect my hedge item, which is a USD. So, and this is called a derivative. Now, this is not the only example of derivative. If you speak, what are derivatives? So there are a few examples of derivatives. Derivatives. What are derivatives? The first one, I would actually consider futures. I call it future. The second one, I call it forward contract, which we just did. The third one is called options. And the fourth one is called swaps. So you've got 4 types of derivatives: forward, future, option, and swap. And this one which we did, that's a forward contract. Now then, what is future? Now listen, future and forward, they are quite similar to each other. They do the same job. Their purpose is same mostly, but a future contract is a standard contract, okay? A standard contract with the standard terms. What do I mean by standard? Like amounts are fixed. Like you go to the money market and you can buy futures like $50,000, $100,000, $200,000, $500,000, or $1 million. These are standard amounts. And then the dates are also standard. The dates are, say, 15 days, 30 days, 45 days. So you can buy a 30 days future for $100,000, or you can buy a 30 days future for $500,000. Amount is standard. You cannot change the amount. It is 100,000. And date is standard. It is 15 days. You cannot make it 17 days. The job is the same. The purpose is the same. Only it's a standard thing. In case of forward, it is customized. Customized means that it is written according to your need. According to your need. What do I mean by that? For example, let's suppose that you needed something like $273,450. This is what you have to pay. So my invoice is $273,450. This is what I need to pay. This much of dollars I need. Now I cannot buy it from future because future are only 100 or 200 or 500. I need 273. And probably I need to pay in 23 days. So then there are future contracts are not in 23 days. Future contracts are 15 days, 30 days, or probably 45 days. So a future contract will not solve my job, because a future contract will say you can buy 100K or 200K for 15 days or 30 days. I need 273. The amount is my very much specific, and I need it in 23 days. I don't need it in 15 or 30. So if I've got a specific requirement, I go for a forward contract. But if I can live with the standard terms and conditions, I will buy a future. Okay, then comes the options.
Sir, which is cheaper? Like if we go into a market and compare, so a future contract is cheaper or a forward contract
is expensive, future is cheap.
Okay.
So what will happen? Now a standard contract is there, and this is my customized. But then imagine I'll just delete all of this data. Imagine that on 30th of April, when the execution time comes in, what will happen? That the market is 3.5 AED. Now, if the market is $1 is equal to 3.5 AED on that execution date, you will feel regretted. You will say, you know what? I made this thing, I paid $2,000, and now again I will go and I have to buy expensive because the contract is 3.7 AED. And why I should be paying 3.7 when the market is already 3.5? I can buy from the open market at 3.5, but because of this insane contract, I have to pay more. You will have regret. In order to protect yourself from such regret, you get options. You make an option, and I would call it a call option here. So a call option is what? A call option is also a kind of a forward contract, but with addition as an option. An option means, the option means here, option gives the holder of the instrument a right to execute or lapse. So this is what an option it gives you. An option gives you a right to execute or lapse. Let me write it down somewhere down below here. Right to execute or lapse. What does that mean? Which means that on 30th of April, when the time will come, I will see how much is the market. It is 3.5. How much is my contract? It is 3.7. I say I'm not interested in executing the contract. I have this option. So it is no more my obligation. It is no more my liability that I must go there and buy it at 3.7. If it says option here, if it says option here, then it means that it is my right to decide what am I going to do. Am I going to execute it or not? If the market is more suitable, I will say I will lapse the contract. Lapse means let it go. Lapse means let it expire. But if the market is like 3.8, then I will go and I will execute, because then it gives me some benefit. So if the contract gives benefit, I will execute. If the market gives benefit, I will make a lapse. So an option, actually, if you have understood so far that whether we speak about forward, future, or option, all three of them, they are doing the same job. The only thing is that there are some features which are different. Future, the first one, it was the simplest one, and it is the cheapest one because it does not protect you fully. I needed 273. It is giving me only 200 or probably 300. So future does not solve all of my problems. So it is cheaper usually. Forward contract is a little bit better than future because it is giving me 273,450, exactly 23 days. So I'm willing to pay a little bit more for that. But it does not decrease my risk. My risk is still there because if the market is 3.5, the contract has a risk because it is making a loss. So then in order to avoid that risk, I make it an option. I say make a forward contract, but write it down option. And I write down call option. Call option means right to buy because I am buying dollars. I'm not selling dollar. The other word is put option. Put option means when you have to sell, an obligation to sell. So I make it a call option, and that should be a little bit more expensive. And these all are examples of derivatives. These are nothing else, but these are the examples of derivatives. Then comes swaps. I would not speak a lot about swaps. Actually, these things we discuss a lot in your F9 as well, especially swaps. Swap is there. You have two types of swaps. I'll just give you a very brief thing. You call it interest rate swaps, and you call it exchange rate swaps. Exchange rate or interest rate swap means you shift something, you toss something, you change something, you flip something. So when you are exchanging interest rates or you are making some exchange in currencies, we call it swaps. You don't have swaps also very much focused in your F7 syllabus, so I don't think that there is big need to discuss it. But there are only two types of swaps: interest rate and exchange rates.